Hey guys, it is Julie here with TipRanks. Today we're taking a look at 3 top analyst tech stocks, all priced under $10 per share. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at 3 top analyst tech stocks. These are stocks that have picked up buy ratings from 5-star rated analysts, and they're all priced at under $10 per share. So today we're going to take a look at these companies, what it is that they do, and what those analysts are predicting for the stock's future. Of course, some of these smaller cap companies can come with some extra volatility, so please make sure you always understand the risk versus reward and do your own research and due diligence. If you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Now let's get right into our strong buy cheap tech stocks. First on the list today, we're taking a look at a company called Cantaloupe. Cantaloupe trades under the ticker CTLP, currently priced at $6.57 per share. Over the past year, they have been a bit on the decline here and are fairly flat and have fallen 11% year to date, but in the last 3 months they have picked up about 6%. Cantaloupe is focused on the retail of the future with their micropayment processing and point-of-sale innovations. They empower businesses of all sizes to provide self-service experience for their consumers, providing operational and payment platforms, both the software and the hardware, for the next development of unattended retail kiosks. Their products include e-port devices for cashless payment, software to track sales, analyze sales data, and automate services, plus coordinate product delivery. Their fingerprint can be found in a wide range of industries, from amusement and entertainment to hospitality and quick-serve restaurants. Founded back in 1992, they now have over 30,000 customers and 54 active payments with 1.2 million global connections. Cantaloupe just shared their third quarter earnings report on May 9th. Now they did have mixed results with an earning beat and slight revenue miss, with revenue of $67.9 million missing by 1.75, though it did grow 12% year over year, and you can see this steady increase on the chart down below. For their earnings per share, they came in at 6 cents, beating estimates by 2 cents per share. Their chief executive officer said that while subscription revenue has grown slower than anticipated, transaction revenue growth is exceeding expectations and achieving higher profitability rates sooner. Following that Q3 earnings report, we had several 5-star analysts weighing in, one of them coming from Barrington. The analyst noted that the company's third quarter results were better than anticipated and that Cantaloupe demonstrated effective cost management and operational efficiency, maintaining a stable ratio of operating expenses to sales. They also noted an enhanced take rate, an uptick in active devices, and larger average transaction sizes. With 4 current analyst ratings, the Cantaloupe stock does come in as a strong buy with unanimous buy ratings. And analysts' average price target comes in at $10.75, which would imply an upside potential of over 63% from current prices. Looking at our ratings down below, 3 out of 4 are 5-star rated analysts, with the other being a 4-star, and 3 all come in with an upside of 51.75% and a high-end price target of 97% upside. Our second top analyst tech stock is a company called PaySign. Their stock trades under the ticker PAYS, currently priced at $4.94. Year to date, they have climbed 77%, including 53% in just the last 3 months. PaySign offers payment solutions for businesses, consumers, and government institutions. They specialize in corporate incentive products, payroll cards, general purpose reloadable cards, and travel cards. Their tailored solutions can reward productive employees, deliver patient affordability solutions to the pharmaceutical industry, disperse funds to networks of freelancers or vendors, and build customer loyalty, to just name a few. They just shared their Q1 earnings report a couple of weeks ago on May 7th, where they did report an earnings and revenue beat. For their first quarter, they did report earnings per share of 1 cent, which was 1 cent ahead of expectations, and this is another company we're seeing those revenues steadily grow. They reported Q1 revenue of $13.2 million, which did grow 30% year over year and beat expectations by over $800,000. They said looking ahead at the rest of the year, they do anticipate continued growth across all business units and are particularly optimistic about the future of their patient affordability business, given its robust pipeline and our swift addition of new programs. Of course, following this earnings report, we did have several analysts weigh in, including a 4-star analyst from Ladenburg Thalmann. They increased their price target on the stock following the company's strong financial results and management's comments concerning traffic patterns and the potential for increasing number of new pharma programs in the year ahead. This points to solid revenue gains through 2025, and the firm believes that the company's pharma segment is now the primary driver of revenue growth. The PaySign stock also just has 4 current analyst ratings, but all coming in with a buy. And their strong buy consensus comes with a price target of $6.17 for an upside potential of nearly 25%. Looking at our analysts down below here, a lot of 5-star analysts weighing in. Low-end price target has an upside of over 10%, and our high-end price target from Barrington has an upside of nearly 41%. If you've made it to our third stock today, this is your friendly reminder to make sure you hit that thumbs up button. Our third top tech analyst stock is Grab. They trade under the ticker GRAB, currently priced at $3.72, and you can see they've had a lot of ups and downs this past year. Overall, they are up 21% in the last year, gaining nearly 18% in the last 3 months. Grab is Southeast Asia's leading super app, offering ride-hailing services, food delivery, and digital payment services. The company came to the public market via a SPAC back in 2021. And the $40 billion business combination that took Grab Holdings public was a record-breaking transaction as the largest ever U.S. equity listing by a Southeast Asian company. Not only does the company offer delivery services for food, groceries, and packages, along with taxi and ride sharing, they also have financial services, including insurance, plus other programs where you can book hotels, send gift cards, and earn rewards. Grab shared their Q1 earnings report on May 15th. Now, they did have a wider than expected loss per share, but did report record EBITDA and also increased their future EBITDA guidance. And looking at the chart here, you can see they have been trending in the right direction with that positive earnings per share and some steady revenue growth occurring as well. For the Q1, they reported a loss per share of 3 cents, which was 2 cents wider than anticipated, while for revenue came in at $653 million, which did grow 24% year over year. Their adjusted EBITDA improved by $129 million year over year to an all-time high of $62 million, leading the company to increase their future guidance, and the company said that they remain focused on continued improvements in profitability as demonstrated by their 9th consecutive quarter of group-adjusted EBITDA expansion. Following that quarterly report, one analyst from Deutsche Bank did resume coverage on the Grab stock with a buy. They said, with mobility demand being stronger than expected, management lifted guidance for adjusted EBITDA, and the firm views Grab's Q1 results as solid, saying lower corporate costs help profitability. The stock has gotten a bit more analyst attention with 11 current analyst ratings, and once again, we do have unanimous buys. Analysts' average price target comes in at $4.57 for an upside potential of over 22%. Looking at our ratings down below, some of our 5-star analysts coming in here with price targets ranging from 7% upside all the way to 61% upside. That benchmark there is our high-end price target, and our low-end price target does come in at 2% from JP Morgan. So that is a quick look at 3 tech stocks, all priced under $10 per share and with a strong buy consensus from some top-ranked analysts. Let me know your thoughts on these companies in the comments down below, if any of them were on your radar yet and what one you think sounds the most exciting. I always love hearing from you guys. Of course, keep in mind these videos are never a suggestion to buy or sell any specific stock, so please make sure you always do your own research and due diligence. Thanks so much for watching. Have a great day, and I'll see you back here next time.